Hi everyone, let's take a look at problem 20-2, which is a lease versus buy problem. Okay, the problem reads, assume that Reynolds' tax rate is 40% and the equipment's depreciation would be $100 per year. If the company leased the asset on a 2-year lease, the payment would be $110 at the beginning of each year. Now, if Reynolds borrowed and bought, the bank would charge 10% interest on the loan, and the question asks us to determine whether Reynolds should lease or buy the equipment. Okay, well, what I've done is I've staged the problem in front of us. We'll take a look at owning the equipment and evaluate this using present value versus leasing. Okay, now let's cover the lease first. 2-year lease, the payment would be $110 at the beginning of every period. So we can essentially assume, I'll just turn the colors back on here, that we've got payments that look like this. Okay, so to evaluate it, we want to look at a common period, and we will look at from now until the end of the second year. So that means we would have a payment now to cover the payment for the first year, and then we would have another payment at the beginning to cover the second year. Okay, let me hit the F2 key so you can take a look at how I came up with $66 as the proper amount. I took the $110, made it a negative since it's an outflow, and multiplied it times 1 times the tax rate so that we can see what the after-tax payment amount would be. Okay? And then the second year it's the same amount. Alright, now to evaluate that, use the net present value formula. At least that's my approach. Let me show you how I come up with a negative 126. Use the net present value. Use the after-tax cost of debt. That's the correct rate to use of 10%. And then the cash flows you want to demonstrate run from the cell F12 to F13. And you really could leave F13 off since there's no amount. But I'm trying to show the same calculations versus owning. And then I add back in the negative 66 from period 0, which means we need to pay for it now. You want to add that to the end of an NPV formula so that you treat it as if the payment was at the beginning of the period. Okay, so the present value of $66 really is the $66. Of course, it's a negative sign. Okay, so that's the leasing alternative. Now, when we go over to the owning alternative, here's what we see. Okay, what we see is we're going to have to spend $200 to buy the equipment. And the assumption there is, since they've told us that the equipment's depreciation would be $100 per year for 2 years, we assume that there's no salvage value and the cost is $200. Okay, so that explains that outflow of $200. Next, we need to look at some positive cash flows, and this really is from the depreciation shield. So what we do is we take the $100 of depreciation times the 40% income tax rate, and that positive effect provides us with or what it's called is the tax shield from depreciation, and that has a positive effect for the company at the end of year 1 and at the end of year 2. So those are the relevant cash flows for the owning. Now we provide that same NPV formula where we use the after-tax cost of debt. Oh, and by the way, I should make both of those 6%, not the 10%. Let me do it the long way. 10% times 1 minus 40%. Okay, and then I can copy that here when we would use the after-tax cost of debt of 6%. Okay, and then we look at the cash flow of shown in cells D12 and D13, and then of course add back in the present value of what you're paying out today, and that doesn't go into the NPV formula because the NPV formula assumes that cash flow occurs at the end of the period, and that's why I have D11 added outside. Okay, so the end result is it will cost us $127 to own the equipment. It will cost us $128 to lease. So it's fairly close, but we are better off owning it in buying the equipment rather than leasing it. Now, if you were thinking of these in terms of thousands of dollars or millions of dollars, then of course that difference becomes sizable. But this is just a quick demonstration to show how you lay out the relevant cash flows and then use net present value or present value concepts to evaluate which one is the better alternative.